If you're a small business owner weighing IUL versus Roth IRA, here's the reality most high earners don't see until it's already costing them real money. Roths don't fail. They top up. And they usually top up right when your income, your business, and your responsibility finally scale. This isn't about criticizing Roth IRAs. They work exactly as designed. The problem is what happens when your life gets bigger than the container. Because this is where most high earners get burned, thinking a capped account can support an uncapped future. So stay with me, and in a minute, you'll see exactly where this breaks. Hello, my name is Robert Balgach. I'm the founder and CEO of Black Swan Insurance Group. And since 2017, we'll help more than 20,000 families design tax-efficient wealth structures supported by 850 plus five-star reviews. We don't sell products, we design outcomes. So if you would like to see how this applies to your situation, you can click on the link below and you can book a tax-free wealth strategy session with us. Calm, fiduciary, no pressure. But first, let's put Roths back into their proper lane. Meet Sean. Sean is 41 years old. He owns a landscaping company with multiple crews, trucks, and long-term commercial contracts. His income averages between $300,000 and $400,000 per year, but it's seasonal. And money comes in fast during spring and summer and goes out as fast during the winter. There's no employer 401k, no pension, just the business, the equipment, and the cash that stacks up in good months. Sean's CPA had him open a Roth IRA years ago, and he contributed when income allowed. As income grew, he ran into modified adjustment gross income, MAGI limits, the IRS formula that decides whether you're allowed to contribute the rent. Some years he backdoored, some years he did. What Sean didn't realize yet was that the biggest risk wasn't returns. It was needing money at the wrong time and finding out his best account wouldn't let him touch it. And that's where the teaching begins. Point number one, Roths work until scale shows. Roths don't break, they run out of room. A Roth is like a one-car garage, perfect when you're starting out, but embarrassing when you're running crews, trucks, and real equipment, and still pretending that's enough. Now, let's be generous with the math. Assume Sean maxes a Roth IRA at $7,500 per year, every year, from age 41 to 65, and even assume a 10% annual return, which is really a best case scenario. No major bear markets, and also retiring at the top of the market. So after 24 years, this Roth would grow to roughly $780,000. Tax-free? Yes. Clean? Yes. Enough to replace business income and retire at 60? Not even close. And this wasn't a loophole, it was a rule book. And the IRS is your silent business partner and enforces contribution caps with precision. Sean didn't have a savings problem, he had a scale problem. And in a minute, you'll see why relying on that balance at the wrong time quietly blows up the plan. Point number two, excess beats balance. Money behind glass doesn't help when things get hot. And Sean put it this way, it's like owning a fully paid off truck that you're not allowed to start driving until age 59 and a half. And that's exactly what Roth really is. If Sean touches earnings before the retirement age, he is hit with ordinary income tax on gains, 10% IRS penalty, and a permanent loss of future tax-free growth. That's not flexibility. That's a tripwire. What Sean had actually needed wasn't a retirement income yet. He needed $50,000 to slow down, reshuffle crews, and transition safely without selling equipment or squeezing cash flow. And this is where structure beats speculation. Sean's IUL was designed as a liquidity system under IRS Code 7702, not an investment, not a gamble, and he was able to access $50,000 through a policy loan. No tax bill, no penalty, no approvals. Both policy and the business stayed intact. Liquidity is oxygen, and oxygen only matters when something starts burning. And in a minute, you'll see why the same access solves the biggest risk of all. Point number three, timing risk is the silent kill. The market doesn't care when you need the money. If Sean retires at the top of the market, everything looks fine on paper. But if he needs income after a 20% bear market correction, that $780,000 Roth instantly becomes about $620,000. Then withdrawals start, losses lock in, and recovery math turns brutal. And that's the moment most owners realize that didn't retire, the market decided for them. This isn't about beating the market, it's about surviving it. And IUL is built for this exact reality. With an IUL, zero is your hero. Floors matter, caps matter, and the loan strategy matters. And costs don't kill IULs, bad design does. And this is where most high earners get burned, trusting averages instead of structure. So let's finish Sean's story. Sean funded a minimum death benefit, maximum cash value IUL with $50,000 per year for 20 years. By age 50, the policy shows roughly $562,000 in cash value. By age 60, the illustration is projecting approximately $1.7 million. From there, the policy is structured to generate about $157,000 per year in tax-advantaged income, with flexibility, liquidity, and control. No forced distributions, no selling assets after a market drop, no asking permission to access this gap. Now, compare that to the best case Roth. A Roth maxed at $7,500 per year for 20 years, growing at 10%, retiring at market highs, reaches about $429,000 at age 60. It's locked until retirement, fully market dependent, vulnerable to timing risk. The IUL reaches nearly double the value 5 years earlier with access, flexibility, and downside buffering, without triggering taxable income, without selling assets after a market drop, without asking permission. So Sean didn't beat the market. He beat tax drag, volatility, and timing risk. His Roth still exists. He just stopped pretending to be the only solution. And the uncomfortable question is this. If Roths are the best tax-free options most owners know about, what does that say about how understructured most wealth plans really are? This wasn't about replacing a Roth. Structure replaced hope. So if you're a business owner with variable income, limited retirement options, and growing frustrated with contribution caps, this is the inevitable next step. You can click on the link below and you can book a tax-free wealth strategy session with us to see if this potentially can fit into your retirement arsenal. And remember, it's not what you earn, it's what you keep. Enjoy it.